Last time we were looking at loanable funds theory and the different sources of loanable funds and the different demands for loanable funds. Right. So at the end of the last video, we finished talking about government demands for loanable funds. Right. These change over time, but businesses also have shifting demands for loanable funds. So an example of maybe something you wouldn't think of right now, but there's a big demand for. It gets a little weird. So there's a big demand for loans for companies to then turn around and buy their shares. So the overall number of shares decline. It returns cash to investors, but drives up earnings per share overall. So this is it's a way to make earnings per share increase. Executives like it because they're often evaluated based on earnings growth. So it's a way to juice earnings growth without actually having to improve the actual business. It just requires having enough funds available to do these repurchases. So that's a demand for funds to buy their own shares back that has been high in recent times. But there are others. So if you think, for example, in the middle of the financial crisis, right, so actually just as we are emerging, there are probably a bunch of really awesome investment opportunities, right? So investment opportunities were high. And so there were huge demand, there would be a huge demand for funds because of the increased opportunities. Now, unfortunately, supply was really low. So if you have high demand and low supply, it's going to naturally drive up interest rates. So when interest rates are high, that leads to lower demand naturally, right? And it's really easy to see why. I mean, if I have, let's imagine that I could launch a Snickers energy bar. That was my classic example. Then Snickers actually launched an energy bar after. I don't think they didn't take their cue from me, but I thought it first. And then as far as I can tell, it's gone. So my incredible idea turned out to be incredible and then not so incredible. But we can imagine, right? So Snickers energy bar, maybe I invest in a Snickers energy bar, and that's good for something like 6% return for annually. So it's a decent idea. By the time you pay for all of the market development and the branding and the food science and supplier relationships and blah, 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 you end up getting a 6% return. Well, if loans are at 8 or 9, then this isn't going to work, right? I don't want to borrow at 9% to earn 6. I'm losing money at that point, right? So that means I never launched the energy bar. So the level of interest rates can affect whether or not it's a good idea for companies to spend. When interest rates are low, they have suddenly a bunch of things that are now profitable that didn't perhaps used to be. So expected future profitability versus risk. So if I have high profits and low risk, it's very appealing to invest. If I have low profits and high risk, it becomes really not, it becomes hard to want to, and that would drive demand lower, right? Lower demand, and where it gets interesting is when these move together, right? If profitability is high and the risk is high, then it becomes a statistical question whether on average which one is bigger. And there's some simulations you can do of that in Excel. Also, there's some statistical. There are statistical functions in Excel that can do that as well. We aren't going to try to tackle that in this class, but if you were, and so at least if we teach managerial statistics class, you might run into something like that. But regardless, right, more profitability makes demand for funds increase, or we have more opportunities, more demands to invest to capture those high profits, and with risk having the opposite story. Expected economic growth. So if the economy is growing rapidly, then even without new investments, our existing investments will have bigger markets to sell to. So, the phrase, the rising tide lifts all boats. So that's also true for business. If they have really strong economic growth, that provides lots of opportunity for businesses, even in their existing, product lines and investment plans and everything, right? And so that would drive demand. So we have all these factors, right? We have factors that cause, right? So if we have a war, it's going to suddenly increase federal demands for funds. If we have new technology like the internet, it's going to suddenly demand business demand for funds. So we have these shocks that can have, you can have demand shocks and you can have supply shocks, right? So we have these lots of different shocks that can happen that cause these curves here to move around. So here on the left, we see we have a negative supply shock. So something happened and supply of funds has declined, and so as funds decline, right, as supplies decline, we have less funds available, and so that means we're going to so that red is going to shift from the red down to the blue, right? So we go from red to the blue because we have smaller supply, but we still care where the intersection is, right? So that we have this new intersection that's shifted to the right, meaning that the right, that we have this new interest rate and we have a new quantity supplied. And okay, so hold on, we have to, and let me make sure. So if we look at this actually, right, so the blue is actually a shift up in supply, right? Let's see, hold on, let's see. So if I have the red, right, so there's my red, and for a given level of interest, right, I now have, if I go from red to blue, for a given, so it's actually, so you don't go up, down, you go left, right? So if I go from red to blue, I'm actually shifting right, which is an increase in supply, right? I shift right, it's an increase in supply. And that is going to lead to a decline in interest rates and an increase in lending, right? So it gets, yeah, it's hard to keep track of which way is going which way, but we see the right. So we see that equilibrium. We go from E to E star. The new E star is at a lower rate and a higher quantity because we have an increase in supply. Right, if you do that backwards and go from blue to red, then you have a decrease in quantity and an increase in the interest rate. So now over on the left, we can have the same sort of thing. So as we move from the green to black, demand has increased, and so interest rates have increased and quantity has increased. So yeah, so the demand side's a little easier to see, but you end up, right, the point is you end up at a nuclear equilibrium. The shifts, right, a shift to the right of the demand curve is going to shift up the equilibrium interest rate. And a shift to the right of the supply curve is going to shift down the equilibrium interest rate. So what causes these things to shift? So we can think of, let's just imagine some scenarios, right? We can run through some scenarios and just think about it. So actually, there are some in the slides. So let's just start with wealth, right? So if wealth increases, you can think about this, right? If there's a bunch more money, right? So what's going to happen? We have a whole bunch more money. That's going to lead to a lot of people looking to loan out that money, right? We have more wealth, more income. We want to loan it out because we don't necessarily need to spend it. We want to invest it. So that's going to increase the supply. So an increase in supply is going to cause that supply curve to shift to the right. And we saw previously, right? When it shifts to the right, we get lower interest rates, higher loans, right? So higher wealth should lead to an increase in supply and therefore a decrease in the interest rate. And an increase in the amount of funds loaned, right? That Q, that's that Q on this side, right? Q goes up. And what about risk, right? If risk is high, that's going to cause lenders to back away, right? So they'll want that will cause a supply shift down to the left. And also, right, it will cause borrowers to be more hesitant too, right? So everybody kind of backs off. But what ends up happening, right? So you have, because there's less supply and less demand, you may not see a shift in the equilibrium interest rate. Now it says here higher interest rates. Why? Because the risk premiums have increased, right? So the amount of funds might be similar, and the rates at which it happens would be similar, except for now we're charging a higher default premium, right? So up here, these models are all risk-free models, right? So without risk, you can still get these differences because we have other things we can do with our money than lend it out risk-free. We could also consume, right? We could, as a consumer, I could go on a vacation instead of investing if the interest rates aren't good enough. So you don't need risk to cause this to happen. But if we have it, it's going to cause default premiums to increase. So what happens to the equilibrium interest rate absent default is kind of depending on which of these is the bigger force. So it's probably more like a neutral, but the risk premiums will go up. So near-term spending needs. Let's think about this, right? So if businesses have a bunch of money they need to spend right now, okay, let's think about consumers first. So if I have consumers and I have a bunch of money I need to spend now, that's going to reduce my ability to lend to the market, right? That will cause a supply shock, a decrease, right? So when supply decreases, we get increase in interest rates. Now it's different if we have short-term spending for businesses, right? If businesses need to spend a lot in the short term, that would actually drive demand, right? It would drive demand for loanable funds. And so then you have high demand for the same supply, and you end up with higher interest rates, but it's through a different channel. Rather than a decrease in supply, you have an increase in demand. Monetary expansion, right? So we have the central bank turn on the printing presses, or even that's not really a thing, but you can have policy decisions that effectively increase money supply in the same way, right? So we have an increase in the money supply. That means there's more money out in the system, right? Suddenly more money out in the system. That money is then going to get turned around and lent typically, right? So the idea is now you have the cash, go lend it. Now if that doesn't work, right, that doesn't work if everyone's panicking and buying 30-day government loans. But in an environment where it actually makes sense to invest in business, if there's a lot of monetary availability suddenly, that money should then leak out into business lending. So then you have, right, so what's that going to do? That would cause an increase in supply. Increases in supply lead to decreases in interest rates. Okay. So again, so this is sort of, these little cases are a good example of how you can think through implications of different events or facts, right? So thinking about if you're writing a paper about the moral political issue, and you were thinking about the economic implications of say an immigration policy, right? So if I have an open immigration policy where I let a lot of people come in, either legally or illegally, it doesn't really matter a ton. If you have a bunch of people coming in, that's going to affect the supply and demand for labor, and so you can think through implications of what that would be. So these are like a good, test cases for thinking through that kind of logic. And we've got more of them. There's lots more things that can happen. So economic growth, right? If the economy is growing, that's going to cause, businesses will, right? If they see growth, that will mean that there's more opportunities for them to invest, right? Growth provides investment opportunities. And so if they're growing, that would increase their demand for funds. Also, right, economic growth means that that the businesses are doing well, and so suppliers of funds have more money. So you end up with an increase in demand and an increase in supply. So then what happens to the interest rate? Well, it kind of depends on which force is bigger. So in general, though, rapid growth tends to cause rates to rise because, again, right, awesome economic opportunity is going to be demand, right? It'll say lots of people want to invest, like invest. But the returns from those investments are trickling in rather than flooding in, right? So that supply effect would get swamped by the demand effect if things are really good. But if they're like marginally good, then who knows, right? Okay, so now this next one, we're going to have a phrase we're going to have to tackle a little bit. So this is utility derived from assets. So this is how much oh god, I mean, in finance class, I call these happiness points, or how much value are we getting out of things. If we have an increase in value that we get out of something, that can matter. So, great example, right? If you had an internet-enabled computer, and when I had this, I had an opportunity to access Prodigy. It's the old online system. You would dial in with your modem, and you could get onto this system where you could actually walk through kind of this landscape, and there were different games you could visit and stuff. But then they would charge you, so it was like $1 to play this game, or and there were only so many hours you could use the system before you had to pay to use it more. But it was still really incredible, right? You could go and you connect into the system through your phone and have these amazing experiences. But obviously, right, this is so incredibly inferior to the World Wide Web that followed, even on dial-up, right? There were the amazing things that could happen. The total Wild West is open, and all this e-commerce and everything, right? Same assets, right? So the technology of the internet made these existing computer assets suddenly have a lot more utility for people. So what would that mean? So if assets suddenly have a lot more utility, we have so if you think about individual consumers, right? Your assets suddenly have more utility. So that means you're going to want to buy more of these assets, right? They're worth more to you. So relative to just investing, now you have the consumption is competitive, right? So that would increase it should decrease the supply of loanable funds from households, right? Because they're busy buying these assets that are so great for their utility. And then at the same time, you think about demand, right? Now businesses all want to be producing these assets that are so great. And so you would end up where it's a self-reinforcing both directions, right? Supply is down, demand is up. So you end up with higher rates. So what about the next one? So restrictive covenants. So this is something that happens on bonds, right? So if I do a loan, I can say, your loan is immediately due if you do one of these 7 things, right? So if I have a big long list of really restrictive rules that ends the loan if you violate them, okay? I can put those on there, right? What's that going to do to the supply? So restrictive covenants are going to increase the supply because I'm protected, right? Covenants protect my investment. And so I'm more willing to lend at those covenants. But as a borrower, right, these could be onerous, and so that's going to reduce my demand. So, if we have an increase in supply, a decrease in demand, the net effect, right, is going to be a reduction in the equilibrium interest rate. And that just makes sense, right? If you're offering something with a bunch of restrictions, it's going to be more valuable to the party that's protected and less valuable to the party that's not. And that would, means a lower interest rate. Tax increase, right? So if you have higher taxes, households have less funds available, decreasing supply. If we have high taxes, then companies are more interested in investing, right? You want to spend the money rather than recognize your profits, and that would increase. And so companies can invest to get out of profits to dodge taxes, but also just in terms of debt versus equity financing, there will be an increased demand for tax deductible debt financing. So you end up with higher interest rates and lower equity. Capital structures will change. The way firms finance themselves will change. All right, currency goes up. So if my currency is more valuable as a consumer, right? As a consumer, suddenly I can buy a ton more stuff. So that's really handy. But so I can buy a ton more stuff. But that's also true for investment products as well. So that's where this gets a little complicated. Right? So all those things happen. But if you think about supply, though, now the currency being more valuable, if we think about foreign borrowers, right? So foreign borrowers would, right? If they expect the currency to appreciate, that they're going to be more interested in investing in that currency, which would increase supply. So this one's complicated. There's actually a lot of factors going on, but so there's a lot of things going on with this one, especially when you think about the foreign interaction. But in general, if your currency goes up, it's going to lead to lower interest rates, and that goes both ways too, right? So higher interest rates makes your currency more valuable, so which would then effectively lower rates. That one's all ends up being very circular. It's kind of a mess. What about, so let's think about expected inflation. So if inflation is going to be high, or if we have high expected inflation, that's going to reduce the supply of funds at that rate and increase the demand for funds at that rate. It's great to borrow if inflation is going to be high because it's cheap to pay it off. You can pay it off with monopoly money at the end of 10 years, right? So this, of course, isn't going to actually work in practice, so interest rates have to rise. So if, at the current interest rate level, sudden increases in inflation are going to drastically shrink the supply of funds and drastically increase the demand of funds. And so those interest rates will adjust quickly. Okay, so lots of different little scenarios we can think about. So they're in actual traded securities that aren't risk-free. There are a bunch of different premiums that will actually get paid. So above the equilibrium real interest rate and the inflation rate, there's also a default risk. So the more likely you are to default, that has to get priced in. Liquidity risk is also relevant. So this is just an interesting feature of the American debt market. Recently issued Treasury securities trade much more frequently than old ones. And so and you actually get better returns on older government debt than you do on newer government debt, even at the same maturity. So everything's all equal. It's a 27-year loan to the government and a 27-year loan to the government, but you'll get a better return on an off-the-run treasury than an on-the-run treasury. But that return comes at a price. That price is that it's very expensive to trade the off-the-run treasury, right? So if you end up having to trade it, you get hit really bad. But if you're not going to need to, it makes sense to invest in the off-the-run. If you feel like you will need to, then you would be willing to pay effectively a liquidity premium to get the one that trades frequently. Right? Special periods like those covenants can cause interest rates to decrease or increase. Maturity, right? The longer the debt, the more sensitive it is to interest rates. If you think about payments that are 7-8 years down the road, hugely change in value when interest rate changes. 30 days from now, who cares, right? If the interest rate goes up to 40%, if I have a 1-month loan, I still don't really care very much, right? But long-term stuff I do. So longer loans are more sensitive to interest rates, and that means the risk is higher. They move more when interest rates move. And so there's a maturity premium. The longer the maturity, the bigger the premium. And so that's partly right. We know, right, if you look historically, if you go look at a 15-year mortgage, it just seems like it's always cheaper than a 30-year mortgage. Not on a monthly basis, right? Your payments are higher, but the interest rates are lower. So there's a very good risk rationale for that, right? Those 15-year mortgages are less sensitive to interest rates than 30 years. But you can think for a second, wait a minute, my mortgage isn't sensitive to interest rates at all. I pay the same payment every day no matter what, every month no matter what. That's true for you, but someone else owns that loan. Right? For the owner of that loan, the value of that loan changes drastically as interest rates change. And it's more drastic for 30-year loans than it is for 15. This is actually like an interesting feature of the American mortgage market. If you've done mortgages globally, it is not really even common to have 30-year fixed loans in other places, right? This is sort of like a unique feature of the American mortgage market. A lot of places maybe they have shorter mortgages or balloon mortgages, or they'll have adjustable rates. Because, right, really, you think about it, well, who in the world would buy these 30-year loans with a fixed interest rate? That's just incredibly risky, right? If inflation is at 12% and I'm stuck getting 4 for the next 27 years, this is a really bad deal. But, so then who's propping up this market, right? Who's buying these 4-year locked-in loans for 30 years? Who would do that? Well, of course, the answer, it's government-sponsored entities that exist specifically to support homeownership in the United States, right? So we have unique features of our American domestic market to support this kind of lending, because it would be really risky otherwise. And again, right, as a homeowner, if you're an adjustable rate mortgage homeowner, now you have effectively a bunch of payment risk, but for the owner of your mortgage, it's much safer because the prices change very little. So a major component of these interest rates is default risk. So this is a graph of default risk over time, default risk premium over time. Obviously, so BAA is, that's sort of like the bottom, that's the worst credit rating that's still considered investment grade. So there's junk bonds. You've probably heard of junk bonds. So junk bonds exist below BAA, but a whole bunch of financial institutions are forbidden from investing in junk bonds. So there really is a bifurcated market, and certain kind of investors buy junk bonds, and then a whole other class of investors buy investment grade. So AAA is the top rated stuff. BAA, or BBB with a different rating agency, is the very bottom but still investment grade rating. So naturally, right, the BAA stuff is riskier, and you can see it carries a higher default premium. But what's interesting here, if you look at this series, is that the difference between AAA and BBB is not constant, right? So if you look into the early 80s, we have this huge spread between those two. It narrows, and then as we get into the financial crisis, it gets huge again, right? So this and that gap tends to mirror when it goes up broadly, but not always, right? So in the early 80s, we had very low default premiums on AAA and very high default premiums on BBB. And then by 1998, there was barely any difference. I mean, you might as well just buy the BBB or the AAA because you're not getting paid for investing in BBB. And then you get to the financial crisis, and once again, now the premiums are huge. So this difference is something that we pay attention to. It's kind of a number that moves the world, and that the spread between these two credit ratings tells us something about default expectations. Right? When it's large, people worried a lot about default. When it's small, not so much. Another factor we think about in terms of a number that moves the world is the yield curve. So, right, if we think about a normal scenario, right, we've already talked through the longer the loan, the more the price is sensitive to interest rates. And that means longer-term loans are riskier, and riskier things tend to pay better, right? The stock market gives you a better return than a CD at the bank. And that's because you have to put up with risk. It's annoying. You better pay me because I don't want to deal with it, right? So longer loans, in general, should have higher rates because of the risk you have to put up with when you do a longer loan. So that would mean, in normal circumstances, that the longer the loan, the higher the rate. And if we graphed it, it would be an upward slope. And in general, it's kind of this curve, right, where we rapidly increase in return and then it levels off as we add years and years. But this is not always the case. So sometimes short-term rates are high and long-term rates are low. So then think through what that would mean. So this is a chance to do implications, right? So why would I lend the federal government money for 30 years or 20 years at 5% or 4% when I could lend it for a month at 10? Well, this seems kind of silly, right? Why would I do that? I might as well just get the 10. It's safer and I get more money. Well, there's a very good reason. And the reason is that if I invest for a month at 10, next month maybe it's 9, then 8, then 5, then 2, and then 0 for 7 years, right? So if I have a strong belief that the short-term interest rate is going to crater, right? It's going to drop to nothing, right? It doesn't matter that I'm getting amazing returns in the short term because they're going to go away and now I'm stuck getting nothing, right? I would rather lock in at a higher rate now while I can And then when interest rates drop to nothing and the long-term rates fall too, I'm locked in at a higher rate. So when this is backwards, it's basically the whole market saying we believe that the short-term rate is going to collapse. So what would that mean? Well, the number one influencer of the short-term interest rate, not as much the long, but the short-term interest rate, are central banks, and in the U.S. in particular, the Federal Reserve. And when does the Federal Reserve make short-term rates drop to nothing? When the economy is in bad shape, is hitting a recession, right? So when we see this, and we call it an inverted yield curve, right? When the short-term rates are higher than the long-term rates, it's demonstrating that everybody is convinced that the Federal Reserve is going to take rates down to almost zero, and that it's better to invest for the long term now while you can. And this is a self-reinforcing prophecy in effect, right? If everybody can look at a chart and see that our economy is headed for disaster, they're going to immediately react as if it's heading for a disaster. And then the Federal Reserve will look at all their dashboards of signals and say, wow, everyone seems to be indicating we're headed for a disaster. We should act to get ahead of it, right? So there's almost a, so it's like a self-reinforcing hysteria, except for usually it's not hysteric, right? It's actually based in fundamentals. And we're talking about this again, right? So the yield curve isn't inverted, but it's flatter, right? It's flattening. And so people are starting to wonder, right? And central banks are saying, oh, well, this time it doesn't actually mean that. But, it's always been, so for the longest time, it's been an indicator of trouble. So we'll see where it goes. So there are other interest rate theories based on expected short curve and on liquidity premium. That's not really important for us. Although I have them in the slides. You can take a look if you're interested. But really what we're doing here is we're setting the stage for why rates, long-term, short-term, look like they do. What are the different premiums that go into them and how inflation ties into that, right? And it's this is the stage on which the Federal Reserve operates. So next week when we get together, we'll be talking about central bank actions and how they relate to all of this. But it's important to put in context what the central bank can and can't do, because the market does in fact move on its own, independent of what the central bank does. So they can drop those short-term rates to nothing, but the American central bank for a long time had almost no control over the long-term interest rate. And that changed slightly in the financial crisis when the Federal Reserve started buying mortgage-backed securities in an effort to prop up, right? So we talk about propping up mortgages, but what it did was it drove down the long-term interest rate, the idea there is, right, if we're driving all interest rates lower, that should spur investment, right? That if long-term rates are low, it would cause businesses to invest, and that would produce benefits in terms of stimulating the economy. So that's where we'll go next time, is with central banks.